whatever success I've had in life has more been due to my knowing how to deal with what I don't know than anything I know. Okay, so how you deal with what you don't know, okay, is so important. So my business in a nutshell is I try to find a bunch of bets that I think are good bets, but to diversify well so that I have a bunch of diversified bets, because I do not know. I mean, in terms of my actual track record, I've probably been right about 65% of the time, okay? And any one bad bet can kill you. So I've known how to deal with that. That's what I've learned, including how to deal with what I don't know.
You're describing an environment where you can't really know anything about the world in 5 years.
I can place good bets, okay? There are some things that are highly knowable, okay? Highly knowable, like they say, death and taxes, okay? Demographics, okay? So I can know or have a view, for example, that I believe owning dead assets is not going to be a good thing. So I could think about alternative storeholds of wealth. I can think about that. I can place some bets that allow me, they're not the certain bets, but I can place enough bets and have enough diversification that I can be relatively confident of some things, but never absolutely totally confident. But I think when we're coming back anyway, that's the reality. I'm just describing our reality the best I can. That's why people who are confident in the future and are just experiencing the present, right now, people are describing, all of them are describing how things are. And almost everybody thinks the future is going to be a modified version of the present.
A pure extrapolation forward.
Things are good. The holy grail of investing is to find 10 to 15 good, uncorrelated return streams, because if you find a number of return streams, a number of investments that are good and uncorrelated, you will have the average return of those, so you don't lessen your return. Just pick ones that are really, really good, that you like, but they're not correlated, but you will eliminate, at 15, you'll eliminate 80% of your risk. So you'll improve your return to risk ratio by a factor of 5. Okay, there's no way you can improve your betting on which one is going to be good by a factor of 5. It's a competitive game out there to pick what's going to be a winner. And then also things change in unexpected ways, as we know.
There's alpha and there's beta, okay? And then we're dealing with the general question of liquidity. Alpha's a zero-sum game. Everybody has to start with a strategic asset allocation mix. We create a balanced portfolio we call an all-weather portfolio, and we have some capacity in that area because it's a passive portfolio that is just holding an asset allocation mix that is not active. In that, we have capacity. In alpha, you have transactions, and you don't want to have, we're closed in alpha. We don't want to take more money. We've decided, we've been closed for most of the last 10 years. So the answer is we don't have capacity, because if you manage too much money, then your transaction costs are going to eat you up. So I think for any manager, the amount that they have is a function really of almost how much they transact. I think we have the most capacity because we deal in all liquid markets in the world. I mean, not only stocks, bonds, currencies, commodities, everything that's liquid. And we tend to move very slowly in those. We take positions in those and we're moving them around. And we're at what I would say is our maximum. And we don't want to take more money. So active management is limited. In other words, I know the boundaries of it, and the limitation for active management is limited. The real issue is how to create a really well-balanced strategic asset allocation mix. Not all that money has come around largely because central banks have put $15 trillion of their balance sheet into buying financial assets. right? So that's put a lot of liquidity in the market. And because of that liquidity and all of that demand, then there's the purchase of all asset classes because they all compete with each other. So there's the competition of, you have a zero interest rate, you have a 2.25% bond yield, and then you have an equity yield and private equity, and everything has an abundance of demand because there's all that money chasing all that number of investments. So as a result of that, there's going to be low returns coming forward, and that's going to have important implications as we're moving. So the answer is that there's not enough for active management. Then you have to deal with the strategic asset allocation risk, strategic asset allocation issue to try to create that balanced portfolio. And then when you take that, you're going to have that in an environment where there's generally going to be low returns because all of that money has bid up the prices of those assets to have relatively low returns. And the real thing that those institutions need to do is to know how to engineer for that.
Hedge funds seem to come and go. Sometimes they're hot, sometimes they're cold, sometimes they go out of business. You've been in business for almost half a century, and you've got $150 billion. What did you do that nobody else has been able to do?
What we were able to do was to be able to structure portfolios in a way that were better in terms of the returns, risks, and correlations of our investment. So to give you that an idea, in other words, you can balance things in a way. I could take different alphas, different bets in different markets, and I could carry that and put that in a fund called Pure Alpha. Then I could take different asset classes and put that in a fund which was called Pure Beta. And then we could engineer it for the customer's risk levels. Do you want it at 12% volatility, 18% vol? And then they would, whatever benchmark they wanted, we could put the alpha on top of. So they could say, I want the S&P 500 plus a 6% vol operating that way. I know it all sounds complicated, but we could design and structure things to their liking that would produce an attractive risk in return that also was not correlated with their other investment. When I would make decisions, I would not just make the decisions. I would think about what are the criteria that I would use to make the decisions, and I'd write them down. Those are the principles. And then in our culture, which is this idea of meritocracy, we would say, are those criteria good or bad? And then we would try to put them into algorithms and equations. And so I would do that almost like a diary kind of thing. And I would see the same things happening over and over again. And the next time it happened, I would go to the principal, and we could together go to our principles. And so it accumulated that over a period of time, and they were practical. They're not theoretical principles, and people seem to find them valuable. So in one sentence, it's an idea meritocracy. The best ideas win out from wherever they come from, in which the goals are meaningful work and meaningful relationships, and we're in it together, through radical truthfulness and radical transparency. So if we disagree, that's a good thing. That's no reason to have anger, and to have the art of thoughtful disagreement and examine how do you scientifically find out what's true, how do you test things, and so on. And that's been essential to our success.
The average person watching right now probably doesn't have $150 billion to manage the investment of. So what can the average person do to invest reasonably well?
Well, I didn't have any money, and I remember the cycle. And what it was is I would start to think, how much money do I have how many weeks, months, and then years can I take care of myself and my family? And I would calculate that. I would be at, 52 years, if no income was going to come in. And then I would start to think, and then if I'm holding a portfolio in something, maybe I could lose half, so I better cut that number in half. And then I start to think of what are my uses of the money? What do I need to do? and I would think about how do I immunize that. And you start and you build like that, and you know how to save. And saving, you know things like don't put it into cash deposits that get eroded by inflation and taxes and so on. And you start to develop it. And the thing that you can do, the most important thing you could do is not be in cash and those deposits, particularly now when there's such negative real rates, and to have a well-diversified portfolio. And that well-diversified portfolio, that's a whole subject of what does that mean and how to do it, but it's a well-diversified portfolio of not just asset classes, but of countries, of different currencies.
And the average person who isn't, a billionaire, should they expect to get a rate of return overall on their money of 5% a year? Is that a good target? 6%, 8%? What do you think is a reasonable target for somebody who doesn't want to take undue risks?
Nowadays, the structure of the markets and where everything is priced, and done the normal way, will give you probably a return in the vicinity of, with a lot of risk around it, maybe in the vicinity of 4%. Okay. 3%, okay, something that might not equal inflation, probably it'd be very close, and then you have to pay taxes on it, because there are so many financial assets. But one thing you can, they'll send you more money. They produced a lot of debt and gave out a lot of money. And so everybody's got money, and it's also very easy to borrow money to buy things. And as a result, if you create much more buying power, then you create goods and services, you've got much more inflation. And the Federal Reserve has been behind the curve, slower to tighten monetary policy. And as a result, we're now starting to see the rise in interest rates to be able to deal with that. As that happens, all assets compete with each other. So now that free money is still going to be cheap money, but it's going to be a bit higher. So interest rates, let's say bond yields, have gone up about 1%. Now you take that and you adjust, everything is the present value of future cash flows, but it means that that interest rate goes up 1%. That means all the other assets have to adjust. We're in a process of making that kind of adjustment. That means the days that we've had before, the easy days where they dump money on you and you don't have much inflation and you don't have much time in this, those are past. And now we're in a different kind of part of the cycle.